Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Returning to the program today for an installment of our Palisade Sprott monthly market update is Rick Rule. Rick, welcome back to the program.
Colin, it's a pleasure to be with you. Thank you.
Rick, gold mining investors are showing concern in both the duration of this pullback, now going on 8 or 9 months, as well as the weakness of mining stocks relative to gold. I think that's a good starting point because this is a change from what we've seen since the inception of this bull market.
Colin, I think we can expand that really to resource commodities other than energy, which has pulled back itself in general. The commodity prices have been relatively strong in the face of a fairly weak global economy, while mining equities, in particular, of course, the precious metals equities, as you refer, have been fairly weak. From my point of view, this is about as good as it gets. We have a situation where the generalist investor and the momentum-oriented resource investor last year pulled commodity equities prices up much further than was warranted by the move in the underlying commodities. The pullback in the equities prices at the same time that the commodities prices themselves have stabilized has traditionally been a very, very bullish factor in the market. It's worth knowing, too, that the higher quality resource juniors have not suffered. What has suffered is the flotsam and jetsam, those that have actually deserved to suffer. We have a stock pickers market where people who paid attention to quality portfolios have performed extraordinarily well, while the generalists who are attracted to the narrative rather than to the reality of resource exploration and development have been punished, as they should. I really can't see a better set of circumstances for intelligent resource investors than the one that we see ourselves in now.
On a previous interview where we discussed at the time gold equity is actually outperforming gold, you made the point that you can make a historical analog to just about any situation, meaning there have been times in the past when the commodity leads and times in the past when the equities lead the commodities, and yet you can find good situations emerging out of both of those. Do you think it really means anything that now the equities are performing weakly against the underlying commodities, or is that just the commodities playing catch up?
No, the other way around. It just means that the equities were overbought. You know, we had a situation where the gold price went up 18-20% last year, and the equities outperformed about 5-1. And importantly, the equities outperformed 5-1 without any reference to quality. That is, the worst of the equities probably outperformed the best of the equities. We had a market where the precious metals equities markets were just entirely too ebullient. The pullback that we had was normal, rational, and expected.
There's a lot of difficulty of trading successfully in a bull market. And uranium, I can see case in point right now. A lot of Palisade Radio listeners who heard us talking about uranium starting back in December probably began buying in January and February, and now some of them are at a loss on their positions after having had a pullback. And it just goes to show that human mentality and trading based on sentiment can be so dangerous to buy and then sell when things start to go down. How do you go about tackling that, Rick, where you can effectively trade and not let your emotions get the best of you?
Well, of course, you must battle with your emotions every day. But the truth is, when a share price doubles without the underlying fundamentals associated with the share changing, it's important to recognize that the share is precisely half as attractive as it was before the price doubled. We had a situation in uranium that was extraordinary. We had a sell-off in the uranium price that had to be temporary and was temporary. And yet when the price moved up from $18 to $25, by the way, both prices unsustainable and both of them, frankly, suicidal for the industry, people who wanted to buy uranium regarded that as a very positive fundamental. It was, in fact, a blip in the market. At the same time, what really happened in the uranium equity market, I think, was that we used up the sellers Bull markets use up the buyers, bear markets use up the sellers, because it's important to note that the very small uranium juniors doubled, tripled, in fact, quadrupled on fairly light volume, which would suggest that there wasn't a lot of buying sentiment, but that the buying sentiment that existed overwhelmed the sellers. Now, the truth is that the best of the best uranium juniors over the next 5 years could be expected to do extraordinarily well. But the move won't really occur until you see, this is my opinion, of course, Japanese reactor restarts, which change the supply-demand fundamentals for the underlying industry. It's important to note, first, that the uranium price over 3 to 5 years has to rise because you're producing uranium at a cost that's higher than the price that you sell it for. In other words, the industry is in liquidation, and the industry can't continue to liquidate. If it does, you'll see very substantial mine closures. That fact being true, right now, there's more supply than there is demand as a consequence of the disruption in the market that was occasioned by Fukushima. What all of this means is that there are extraordinary profits to come, but they might come in the 3-year, 4-year, or 5-year term. Speculators who bought uranium stocks because they had performed in the near term, in other words, momentum-oriented buyers, need to understand that they're going to have to hold this stock longer than a long weekend to take advantage of a 3 to 5 year trade. Those same type of investors who are more traders than investors would be much better off buying in cataclysmic declines than they would be in buying to equally sort of cataclysmic momentum moves to the upside.
Rick, you're tied into the big money players in the mining space more than most, and getting a sense of their mindsets and buying appetites right now in light of the fact that we've had this pullback would be very interesting to me. Has their purchasing kind of philosophy or mentality changed very much over the past few months, or are they still buying deep discount plays just as they were over the last couple of years?
My experience is that the professional natural resource investors, including most importantly, the major mining companies, are uniformly bullish and are making strategic investments now for the 3 to 5 year time frame. Similarly, the professional institutional investors, and when I say professional, I don't mean generalists, I mean those from within the energy and the mining business, are uniformly bullish. They're certainly sober buyers looking for tier one assets with a view, again, to harvesting in the 3 to 5 year time frame. The competition in all aspects of our business, from high quality competitors and the appetite from the biggest clients, is as good as I've ever seen it. This doesn't mean, of course, that this is a market that'll respond in the 2 or 3 month time frame that is so commonly required by momentum-oriented retail investors.
We spoke quite a bit in the past before the bull market started about when was the time to get out, and you've stated, I believe, that that's one of the most difficult parts about being in one of these mining cycles is getting out at or near a top. Ironically, we haven't really touched on that since this bull market's actually started, so I want to go back to talking about some of the parameters that you would use just on a fundamental basis where we are right now to say, and let's take gold for an example, what a top might be. For example, do you have a gold price in mind, and I don't mean a specific gold price, but a double top of sorts where gold goes back up to $1,900 or $2,000 and then the entire bull market is over, would be unprecedented. So certainly, I would think that you have in mind that we'll reach a new high there. Are there any other things you look at from far out point that might indicate we're getting close to a top?
Colin, I think there probably are statistical indicators with regards to that, but that isn't the way I operate. Certainly in terms of market beta, which is really what you're talking about, there are a variety of technical indicators that people use. The technical indicator that I use is in fact human. His name is Paul Wong, and he's the chief investment strategist here at Sprott. And when Paul's bullish technical indicators come into play, and I think we're very, very close to seeing him flash an all-out buy signal. What I have taken to doing is I try and capture beta by buying the Sprott ETFs. In other words, I don't want my individual stock portfolios to be beta or market-oriented. I want them to be alpha-oriented. But I also know, given the huge up move that happened in the gold stocks last year, that when gold is early in an uptrend, I need to own the whole market. And so I buy the ETFs because they limit the risk of single company failure, and they limit the liquidity risk that might happen in some of the smaller companies that I favor. And if I'm buying based on technical indicators, I sell those based on technical indicators. With regards to the companies, and particularly small companies, the situation is very different. What I look to is value creation within the company and the price of the value that is created. It's very common for me, if I buy a stock at $1 and the share price doubles, if there has been no fundamental change in the company itself, it's quite common that I will sell enough of the stock that I have recouped my capital investment, and I become much more patient with the balance. We laughingly call that the point of no concern, to differentiate it from holding a losing position, which is, of course, the point of no return. So in the alpha part of my portfolio, my strategy is much less momentum and market related, and much more related to the price of the opportunity that we see within the individual company. And you own different companies for different reasons. An example would be in mid-2015, I bought a reasonable amount of stock in several companies that had very high leverage to increases in the gold price. These are the so-called optionality companies. Companies that couldn't make any money until gold went through $1,500 or $1,600, but companies that would become extraordinarily valuable in a gold bull market. The truth was that at the beginning of the move in gold last year, these optionality companies were uniformly up 300% with no real change in their fundamentals. I sold them because my premise was simply that they would do well in the event of an upswing in the gold price, and they outperformed my expectations so extraordinarily that I thought it was better to lock in my profits than to see how far that irrational exuberance would extend. By contrast, we've had other companies that have delivered very, very, very good fundamental results. And although they have moved up by 50 or 60%, we still believe them to be undervalued relative to what we think the assets will be able to do, even in the current gold price environment. So it's very much a game in the alpha part of your portfolio of stock selection and stock monitoring.
Rick, there's traditionally a rotation of capital, or at least a perception of a rotation of capital as a bull market evolves, whereas money starts in the majors, moves to development stage, and then trickles down finally to exploration and discovery. And you see the money, the investment dollars kind of heading this way. Do you see this playing out in this current bull market, and where are we at this point?
No, I see the market beginning to change as a consequence of increasing amount of sophisticated institutional capital available lower down the value creation chain. You are seeing large pools of capital, the Van Ex of the world, and large pools of capital in the junior gold mining ETFs, the Sprott ETF and the GDXJ as an example. So what you're beginning to see now is a much more rapid response in the lower end of the market than you would have seen at the beginning of the last bull market. Things have really changed this time. Yes, you're seeing response at the upper end of the market, but you're seeing a more uniform response through the market as a consequence of increasingly sophisticated market participants and also ETFs, which allow people to pay attention to companies that are further down the feeding chain and pay attention to them earlier.
Finally, you've taken over the role of Chief Investment Officer of Sprott Resource Holdings, I believe. What does that entail? Tell us a little bit about that, Rick.
Well, I'm extremely excited about that. Sprott Resource Holdings is the outgrowth of a very successful effort that we began 15 years ago called Sprott Resource Corp. The idea there is that we use the brand strength of Sprott, the ability that we have to assist companies across their entire capital base, and we assist 2 or 3 or 4 teams a year, very high quality technical teams that can benefit from our brand and benefit from our access to capital, and we assist in growing them. We're in the process right now of completing a private placement to complete the recapitalization of Sprott Resource Holdings. And we really look forward to partnering with the best of the best young management teams to bring the capital markets expertise to bear, to work alongside their technical competence, to advance select projects through the balance of this bull market. It's a wonderful thing for me to be able to do at this point in my career, after having been involved in resource capital markets for 40 years and been involved really shaping up the Sprott organization as a resource merchant bank in the last 5 years. I would regard this as a sort of a focal point or a pinnacle point for my own participation in small capital markets in what I think will be a wonderful upcoming bull market and a wonderful circumstance, really, to bring all the talents in the Sprott organization to bear early on in this bull market.
Yeah, being involved in the mining space, everybody talks about the importance of management. And I think that a big component of that people don't discuss is good management teams are able to attract groups like yourself to get behind the company, and that's really where you differentiate the underperformers from the outperformers. So I'm excited to see which companies you guys embrace there.
You know, Colin, one of the things I've learned in my career, and we've talked about this on your show, is the truth of the Pareto principle or Pareto's law, which suggests that 20% of the population base in an activity generates 80% of the productive utility. And in turn, that 20% of the 20% generates 80% of the 80%, meaning that 4% of the population base generates about 65% of the utility. And I know for certain that you can take it one standard deviation further, which means that 0.8% of the population base generates 40% of the utility. What Sprott Resource Corp wants to do is find the generation, find the people in your generation, the Colin Cattell generation, that are that 1%, and allow them to access the brand and the expertise of Sprott to accelerate their careers and accelerate their access to capital markets, at the same time that we allow them to help us identify the portfolio opportunities that have so often come to them. In my own career, early in my career, I had the extraordinary good fortune of working with the Robert Friedlands and the Lucas Lundins and the Bob Quartermains, the many, many people, the Ross Beatties, the many, many people that I was able to find in my 30s and build my career around. My job is to find those people again, but the people who are more your age, where they have the capabilities but don't yet have the reputation that will allow us to assist them in developing their careers at the same time that they make our shareholders disproportionate returns to the rest of the market.
Well, I'll tell you what, I like the Colin Cattell generation. That has a nice ring to it. I hope it catches on.
You're always a brand builder, my friend.
Rick, thanks for coming back on the program. Always appreciate it.
A pleasure. Thank you. Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen, or are you too stupid?